They said it was just another market wobble, until the vaults began to whisper. In 4 days, a pool of silver large enough to sink a small nation vanished from the exchange ledger. Prices touched a new high, collapsed, then surged again, but the drama wasn't in the ticker. It was in the metal itself, registered ounces being drained at a speed the charts haven't seen this decade. Picture this like a reservoir being bled with a fire hose. Only the valves belong to institutions with trillions to lose or win. Tonight, we pull back the curtain on the mechanics that could split this market in two. A shrinking inventory that backs paper contracts, borrowing costs that spike when metal gets scarce, a futures curve that suddenly rebates urgency, and premiums in Asia that whisper who's hoarding and who's selling. One by one, these signals can align and force a delivery crisis, or fizzle and leave prices tumbling back to the shadows. If you want to know not just what happened, but when the system could buckle, and what the first crack will look like, stay with me. We'll map the thresholds that matter, the dates traders are watching, and the scenarios that could turn this into either a measured rally or an overnight rules shift that rewrites the game. They pulled millions out of the ledger, not slowly, not quietly, fast, violent. 4 days that changed the map. Public Vault reports shows registered COMEX silver moving at an extraordinary clip. What normally drains by a few 100,000 ounces a day suddenly accelerated to multi-million ounce withdrawals. That pushed deliverable stocks down in what looks like a matter of days, a fall measured in tens of millions of ounces. This is not rumor, it's on the exchange reports. Think of the market as a dam. Paper futures rest on a physical backing, the registered ounces inside the vaults. When that backing disappears, the paper stops being theoretical and becomes a delivery problem. Short sellers who thought they could settle with paper face the choice: source real metal or face the exchange's delivery rules. That is where a delivery squeeze is born. The numbers matter. Reports from market outlets flagged roughly a 29 million ounce exit from COMEX vaults during concentrated withdrawal periods, a scale that flips normal daily flows on their head. To put that in perspective, if typical daily registered drains are on the order of 200,000 ounces, you're seeing activity more than 100 times greater in those surge days. That magnitude creates acute stress in the delivery mechanism. Why would this happen? Several forces can drive big withdrawals. Industrial buyers need spot metal now. ETFs and institutional players may be converting paper exposure into physical holdings. And sometimes, large players simply require metal for settlement. Whoever's pulling, the effect is identical. The pool of available silver shrinks. The spread between what trades for immediate delivery and what trades for future delivery begins to twitch. Markets sense it. The curve tightens. Urgency replaces complacency. This is where human psychology amplifies the mechanical problem. Fear accelerates action. A trader sees inventory fall. They hedge. Their hedge becomes demand. That demand drains more inventory. A loop forms. The narrative shifts from data to emotion. That loop is what turned a liquidity event into a headline. Scientists and market analysts compare this to hydraulic systems under stress. When inflows can't match outflows, pressure spikes. In commodity markets, that pressure appears as rising premiums, skyrocketing lease rates, and backwardation. Past episodes show these signals precede explosive moves. The evidence is clear in the vault numbers. Now watch the calendar. The next contract expiration acts like a valve. If registered ounces keep falling into that deadline, the market faces a test it hasn't seen in years. Will the exchange force deliveries? Will big players be able to source metal? Or will rules bend overnight? The clock is ticking toward that date, and toward an answer we may not like.
If the drain in the vaults is the heartbeat of the silver market, then the lease rate is its fever chart. And right now, that chart is flashing red. Most people never see this number. It doesn't show up on CNBC tickers or YouTube thumbnails. But behind every ounce traded, every contract rolled, every bar moved from one vault to another. The silver lease rate quietly tells the truth long before price ever does. The lease rate is simple in concept. It's the interest cost to borrow physical silver. When the market is healthy, calm, and well supplied, that cost stays near zero, sometimes barely above it. Why? Because plenty of metal is sitting in vaults, waiting to be lent out. Supply is elastic, liquid, comfortable. But when that rate spikes, it means one thing. Nobody wants to give up their metal. A soaring lease rate is the market shouting. Physical is disappearing. Hoard what you have. It's the difference between a grocery store with full shelves and one where customers are grabbing cans before they even hit the carts. The shelves might look stocked for a moment, but the frantic energy underneath tells you something deeper. Scarcity has taken hold. These spikes usually occur during one of three situations. Industrial demand jumps unexpectedly, solar, EVs, electronics, and chemical catalysts all fighting for the same finite pool of metal. Paper sellers need physical inventory to meet delivery obligations and can't easily find it. Large players begin hoarding for strategic reasons, preparing for a geopolitical, financial, or structural shift. In every case, the math changes instantly. If lease rates are rising, it becomes costly, even painful for banks and bullion dealers to borrow silver. And when borrowing becomes painful, they stop lending. When lending stops, shortages begin. This is why professional traders call the lease rate the ultimate tell. Price can be manipulated. Headlines can be crafted. Even inventory data can lag. But lease rates, they react immediately and violently to scarcity. And that's exactly what we're seeing in the current market environment. An unmistakable upward pressure that signals one undeniable truth: silver isn't being offered. It's being withheld. Because when metal gets scarce, people don't sell it. They sit on it. They secure it. They defend it. And that behavior becomes a force multiplier. High lease rates scare shorts. Scared shorts buy. Buying pushes prices higher. Higher prices tighten supply further. And the cycle repeats with greater intensity. The fever is rising. And every time silver has shown this exact combination, shrinking inventory plus rising borrowing costs, the market has erupted shortly after. The question now isn't if this accelerates, it's how fast everything snaps once the next catalyst hits. For decades, silver's biggest buyers were investors, banks, and funds. They set the tempo. They dictated sentiment. They could move the market with a headline or a hedge, but that era is gone. Today, the whales aren't hedge funds, they're factories. Solar manufacturers, VV producers, 5G chip foundries, medical device companies, chemical processors. These industrial giants are devouring silver at a rate that the mining industry simply cannot keep up with. And unlike investors, they don't buy silver because they want to. They buy it because they have to. Their entire business depends on it. This changes everything. Industrial demand isn't emotional, doesn't care about charts. It doesn't care about macro narratives, geopolitics, or Federal Reserve speeches. It operates on one principle only: secure the metal or shut down production. And shutting down is not an option. The solar sector alone has become a structural vacuum. Every panel requires silver, and with global adoption accelerating, these factories now consume hundreds of millions of ounces per year. EV manufacturers add their own gravitational pull, needing silver for battery systems, circuitry, sensors, and onboard computing. Modern electronics, from smartphones to satellites, require silver for conductivity, signal integrity, and microscale switching that simply cannot be replaced with cheaper metals. This is where the squeeze becomes mechanical, not speculative. Because while demand is exploding vertically, mine supply is flatlining horizontally. Global silver output has been stagnating, even declining in several producing regions, where grades are falling. New discoveries are sparse, and major mines scheduled to come online won't offset the structural deficits already in place. This is how deficits form, not from investor euphoria, but from industrial necessity. 5 consecutive years of demand exceeding supply is not a market fluctuation. It's a structural fracture. And here's the part most people still don't understand. Industrial buyers don't wait for silver to get cheaper. They rush in when they sense scarcity. A solar manufacturer doesn't think, maybe I'll buy next month. They think, if I don't secure inventory right now, my factory shuts down, and shutting down costs millions per day. So they buy aggressively. They buy early. They buy at any price. Meanwhile, investors, the traditional market movers, are only just beginning to realize what this means. They're stepping into a battlefield already dominated by industrial giants who don't speculate, don't negotiate, and don't flinch. In every commodity cycle, there comes a moment when one force becomes so powerful that it rewrites the market's behavior. For silver, that moment is now. The factories have become the whales, and when whales move, the ocean rises. In every commodity market, there are two universes, the paper world and the physical world. Most of the time, they coexist peacefully. Futures traders place bets, roll contracts, hedge positions, and unwind them without ever touching a single ounce of real metal. It's clean, it's efficient, it's abstract. But silver is different, because the moment the physical world pushes back, the entire paper universe begins to shake. Speculators can bluff. Industries cannot. Traders on COMEX can short 10 million ounces with a keystroke. But a solar factory can run a single production line without real bars delivered to their facility. A battery manufacturer can produce a single EV module without the silver coatings that regulate current flow. A semiconductor plant can't fabricate microchips without silver-based conductive pathways. When the industrial buyers step in, all theories, all models, all market psychology becomes irrelevant. They buy because they must, and when they must, they do not negotiate. Speculators ask, "What's my risk if I hold this position?" Industries ask, "What's my risk if my factory shuts down?" The difference between those two questions is a canyon. And in that canyon, silver's most violent rallies are born. Because when the factories begin taking metal from the market, the illusion of abundance collapses. The futures market, built on leverage, assumptions, and the belief that physical metal is always available, suddenly slams into a wall of real demand. A trader can delay. A bank can roll. A hedge fund can hedge. But an industrial buyer cannot afford to wait for calmer markets. They secure the metal now, or they face millions in daily losses. This is why the squeeze accelerates. Industrial buyers don't just buy what they need today. They buy what they need for the next quarter. They front-load orders. They outbid investment funds. They lock in supply before the next big contract expiration. And that puts pressure on anyone who's short the market. Because the more metal industries remove from circulation, the harder it becomes for future sellers to source the silver they promised on paper. The paper market assumes supply is constant. The physical market knows supply is shrinking. This is where reality breaks speculation. We've seen it before in commodities. Copper, nickel, palladium. When physical shortages collide with leveraged bets, the unwind is brutal. But silver is different because its industrial demand is expanding, not contracting. Its deficits are deepening, not easing. Its investors aren't even fully awake yet. So the question isn't who wins, speculators or industry. The question is, who survives the moment the physical market calls the paper market's bluff, and that moment is no longer theoretical. It's approaching fast. Every commodity market has a breaking point, a moment when buyers stop behaving rationally and start behaving like competitors trapped in a shrinking room. For silver, that moment begins the instant the supply chain feels stress. Because unlike gold, which sits peacefully in vaults, silver moves. It flows through factories, refineries, chemical processors, solar lines, medical device plants, aerospace labs, and electronics foundries. And when that flow slows, the calm, orderly world of procurement turns into a quiet bidding war. This is the cost spiral, the transformation of silver from a commodity priced by markets into a resource fought over by industries. It starts subtly. A refinery gets slightly lower output than expected. A recycling facility reports reduced recovery rates. A shipment arrives late. An ETF takes physical delivery instead of rolling. These tiny drops change nothing individually, but together they form the first cracks in the supply chain. Manufacturers sense it instantly. These companies rely on just-in-time inventory. They monitor every shift in the metals they use. When silver availability begins to wobble, they react faster than any investor ever could. A solar producer doesn't wait for confirmation. A chip manufacturer doesn't wait for a headline. They move immediately and aggressively. The first stage of the spiral is advance buying, companies securing the next quarter of supply instead of the next month. This removes additional metal from circulation. The second stage is overbuying, firms purchasing more than they need simply because they fear what the next shortage will look like. And finally comes the third stage, competitive bidding, not for price advantage, but for survival. At this point, the idea of a market price becomes meaningless. There is only the price that secures metal and the price that does not. This is where investors usually wake up, not because of news, but because premiums start exploding. Industrial users pay above spot. Then refiners pay above their premiums. Then wholesalers raise offers because they can't replenish inventory. Suddenly, the futures price everyone thought was the real price becomes irrelevant. Physical metal trades in an entirely different universe. This is how silver transitions from stable commodity to contested resource. And once that transition begins, it rarely reverses quickly. Supply chains operate on momentum. Once they start panic buying, they don't stop at normal levels. They buy until they feel overstocked, and that moment may be months away. The cost spiral feeds on fear, but it's triggered by math shrinking supply, rising demand, and a paper market pretending nothing is wrong. Investors have not fully grasped this dynamic yet, but refiners have. Manufacturers have. Industrial giants have. They are already competing. And when industries start fighting over metal, the market doesn't cool down. It overheats. The spiral has started. The question now is how fast it accelerates once the next shock hits. The silver market is standing at a crossroads. The vaults are thin. Lease rates are spiking. Industrial demand is ravenous. Speculators are caught between fear and opportunity. And the clock ticks toward the next COMEX contract expiration. Every signal points to one undeniable truth. A decisive move is coming. But which path the market takes, parabolic squeeze, measured rally, or correction, depends entirely on thresholds few are tracking. Path 1, the parabolic squeeze. This is the nightmare, or dream, depending on your position. Imagine registered COMEX inventory falling below 20 million ounces. Silver lease rates surging past 50% annualized, and backwardation persisting across the futures curve. These conditions compress the market into a pressure cooker. Industrial and institutional buyers compete for every remaining ounce. Spot prices surge uncontrollably. Historical precedent exists. Palladium in 2020 rocketed nearly 90% in just 8 weeks when similar dynamics unfolded. If a sudden rule change or emergency inventory injection doesn't intervene, silver could spike to $85, $95 within months. The tension is palpable. Every day closer to contract expiration intensifies the squeeze. Path 2, the measured rally. This is the base case scenario. Inventory stabilizes around 25 to 30 million ounces. Lease rates remain elevated but manageable, and backwardation is present but not extreme. Silver climbs steadily, 5 to 10% per month, reaching $70, $75 by March 2026. Short covering ETF inflows and industrial competition sustain the rally. But volatility remains controlled. The market digests each new headline cautiously, debating whether industrial demand can sustain these prices. Here, timing is everything. The January contract expiration acts as a checkpoint. If delivery stress is moderate, the measured rally unfolds, offering gains without chaos. Path 3, correction and reset. The bearish counterpoint. Industrial demand softens. Shanghai premiums fall. Lease rates drop below 20%, or macro conditions, like a hawkish Federal Reserve pivot, push real yields positive again. Silver peaks briefly around $68, $72. then corrects sharply back to $52, $58. The reset recalibrates expectations, redistributes inventory, and prepares the market for the next structural squeeze. Even here, lessons remain. Markets rarely return to old complacency once industrial demand and structural deficits exist. The common thread, timing and thresholds are everything. Inventory, lease rates, backwardation, and premiums form a quartet of signals when one or more cross critical limits. The trajectory is almost predetermined. Historical patterns show that ignoring these thresholds is costly. For traders, investors, and analysts alike, the next 30 days are decisive. Silver may surge, stabilize, or retreat. But whichever path unfolds, one thing is clear. The market is no longer speculative. It is structural. Industrial demand, institutional positioning, and physical scarcity now drive the narrative. The countdown is on. Every data point, every vault report, every premium adjustment could tip the scales. And when the tipping point hits, history suggests the market will move faster than most can imagine. The next move is coming sooner than most expect. Registered inventory continues to fall. Lease rates are spiking. Industrial demand is accelerating. And the countdown to the next COMEX contract expiration is already underway. Every second counts. If you want to see the moment the market tips, if you want alerts the instant critical thresholds are breached, else, this is the time to act. Subscribe and turn on notifications. Every update could mean the difference between watching history unfold or being left behind. Drop a comment below. Which indicator do you think breaks first? Inventory, lease rates, backwardation, or Shanghai premiums? I read every comment and share my analysis with those who engage. Silver's story isn't just numbers on a chart. It's a race against time. And the next chapter is about to be written. Make sure you're part of it.